Hi, I am Alberto Calva from Acus Consulting. I want to tell you about our workshop of investment project financial evaluation. For the last 25 years, I have continuously been giving workshops for executive education. I have had a chance to deliver workshops in 8 different countries. The workshop of investment project financial evaluation is one of the first ones I started giving. It is of great importance to support the decision making on long-term situations. When I give workshops, not only the participants learn. As incredible as it sounds, I keep learning every day. Something important has been to improve the structure of my workshops so they are aligned to business strategy. Also, that the delivery is practical from a real business world point of view. But what will we see in the workshop of investment project financial evaluation? Well, we try to answer some questions like these ones. How do we have to value the long-term decisions that will affect the company? Do you know the meaning, right interpretation, and limitations of techniques like net present value and internal rate of return, also widely known as NPV and IRR? Do you know what opportunity cost is and why is it so important in business decisions? How do you know if a decision helps you to create economic value in the company? Do you know how to calculate the cash flows for a project evaluation? Do you know how to evaluate if it is better to buy or lease a fixed asset? Do you know the real impact of the cost of taking a discount for an advance payment against not taking it? Do you know the principles in which evaluation of a company is based? At the end of the workshop, you must understand concepts and tools that can help us in investments and financing long-term decisions. Key elements in these are the opportunity cost, the time value of money, the discounted cash flows, and the creation economic value in the company and for the shareholder. Let me go into the daily program. It is a 3-day workshop and the structure is more or less like this. Day 1. The first day we start by analyzing the goal of a company and the analysis of long-term decision making. There are 4 elements to consider. The initial investment, the expected future benefits, time in which these future flows will take place, and the time value of money. We start analyzing the time value of money and reviewing why it is based in the opportunity cost and the risk. Also, we talk about the weighted average cost of capital to determine the opportunity cost in the company. We review the general evaluation process, both for future projects and for the review of past projects. 3 general parts: cash flows in current dollars, cash flows in constant dollars, and discounted cash flows. Why is the evaluation a continuous process and it is not something to be done only at the beginning of the project? We proceed to understand how to determine the cash flow for evaluation, both for the project and for the shareholder. Once done this, we go into the review and understanding of the advantages and disadvantages of techniques like payback period and discounted payback period. These are simple techniques, but that do not consider certain aspects that are important in the evaluation. Finally, we go into a deep review of the net present value, the famous NPV. How is NPV determined? What does it mean? How do I have to correctly read it? Advantages and disadvantages of this evaluation technique. What can be a general definition of net present value? How can we use it if we are in the negotiation of an investment project? Why is this the base in the valuation of ongoing companies? What happens with the net present value if we change the discount rate? Day 2. In the second day, we analyze the net present value on a graph, where we do the relationship between NPV and the discount rate. And in this graph, we find the internal rate of return, the also well-known IRR. What is IRR? How is it calculated? What are the mathematical problems for its calculation? What does internal rate of return mean? How do I have to correctly read it? And we make a comment on common misunderstanding errors with the internal rate of return. A large internal rate of return does not necessarily will lead us to choose the project with the largest economic value. Finally, we review the profitability index. Why is it known as the NPV index? Why does it help us to review the present value profitability of a project? How does it help to compare different sized projects? A problem with the profitability index is that it does not give us information regarding the economic value of the project. Once covered the 5 evaluation techniques, payback period, discounted payback period, net present value, internal rate of return, and profitability index, we will go to an exercise where we can clearly find when to use each technique. We base in 4 possible situations. Are these exclusive or non-exclusive projects? And can we take one project only once, or can we multiply it several times at the same time? Lastly, in the day, we review how to do all these calculations using the financial calculator or well with Excel. Day 3. In the third day, we start by reviewing what the annuities are and how are they useful, as well as approximations with using perpetuities. And we get completely in the day into doing exercises and cases on the project evaluation, among others. We review exercises and cases of how to determine the cash flow for the project evaluation, how to measure the increase of value of the company when we have an investment project, how do we use an annuity to determine the attractiveness of a project, how do we use an amortization schedule or amortization table in the analysis, and why the figures have an exponential behavior and not linear. We review cases of mortgage credits and the behavior of principal and interests. We review the decision analysis regarding buying a part to an outside supplier rather than manufacturing it in-house. We review the case of buying using credit and cases of operating leasing. And we look to apply all these long-term decision concepts into the personal finances. After this, we will add to our analysis a tax-deductible situation in the project evaluation, and we analyze again our projects. Why? When expenses are tax-deductible, for example, it is more attractive to lease than to buy. What happens in the case of an equipment replacement? Lastly, we review when we have to do evaluation of projects with different time periods. We close the workshop making a summary of the most important concepts for a project evaluation and what to do in the company in order to use all these as a tool that supports the decision making. I hope to have a chance to have you in my workshop of investment project financial evaluations soon. Have a great day. See you soon.